Good.
Hi, Glenn Haig. Robert Gurman. Nice to meet you.
There was like
Yes, we can. I request.
zinc thing trying to prevent the cold, which I heard him say was, hey, I heard him say it's nice. Yeah, I think it's more.
You catch it in the first 24 hours? Amazing. No, thank you. I'm doing my zinky thing. But I had to do a lot of rustling sounds.
Well, good morning, everyone. In our last panel, we heard from the ISO and the Market Monitor about the markets and some impressions both from this side of the table and from them about how the markets incent investment as needed for reliability and other goals at just and reasonable costs. And now we have, in the next panel, some of the people who are making or advising those who make the investment. I'm a little bit handicapped by not having name tags, so I'm going to ask the, and of course your backs are to the other audience, so, or perhaps there are name tags coming, name tent cards, but I'm going to try to introduce people, but maybe the first time you speak, you can introduce yourself. And we're going to do something, oh, here we are, thank you, a little bit different in this panel, which is we're something I've always wanted to do, so here we are breaking new ground, not having everyone go and talk for 10 minutes and then you just have a couple minutes for questions, but really trying to start a dialogue. So first I will welcome our panelists, Gavin Donohue from the Independent Power Producers of New York, Glenn Hake from the New York Power Authority, Margie Phillips of Direct Energy, Mike Mager of Multiple Interveners, Ray Kinney of New York State Electric and Gas, and Robert Gurman from Pocono Manor Investors. Welcome you all. I would like to start by focusing in on the decisions that you make, and I know many of you do business not just in this geographic market, but in other markets around the country, so you can bring that comparative perspective. But the decisions that you make when you're yourself or advising someone to make an investment, or if you evaluate investments from other perspectives, what do you think are the aspects of the capacity market that are most important to the investment community in making those investments? And are there, you have all your regulators, state and federal, arrayed in front of you. Are there changes that either barriers that you see to getting the right investments made, or changes that you need that you think we should consider? And I'll start with Gavin, if that's okay.
Lucky me.
Okay. Or
no, I'm just kidding. Thank you, Chair. New York, in an effort not to be redundant, I think the ISO's presentation was very well done this morning. I'd like to have the latitude to put a written statement into the record after this is over, because there's some real technical issues that I may not be able to get into the weeds here today.
And we're going to collectively work out what the next steps are at the end.
Okay. What drives the generator community is certainty, not regulatory uncertainty. And I think the other issue is intervention in the marketplace. New York is a strong place, tough place to do business. We have a very active public service commission. So when my members come to me about investing in New York, the constant threat of intervention in the marketplace, whether it's the Lower Hudson Valley Zone issue and fighting that in court, or the AC transmission proposal, depending on where your perspective is on that, and then the overall out-of-market contracts and uneconomic retention of units and uneconomic entry and mitigation policies. Those are the things that really drive decisions lately in New York. Wholesale electricity rates, one of the things that I didn't hear this morning, are really, as a commodity, are very flat over the last 12 years in New York. I know that there's issues surrounding the level of electricity payment and bills, but I think the wholesale electricity markets have a very positive story to say. And the fact that NRG just announced that they're bringing the Bowline facility back, the Dansgamer facility, I think market signals, when administered properly, policed properly, and implemented fairly, will send the correct market signals for the generators in the future.
Thank you. Well, I was feeling bad for putting you on the spot, but you don't seem to have suffered too much from going first. So your answer was certainty and not having market intervention that uneconomic entry in the market.
Yeah, and to address mitigation rules. I think everyone here knows we've had a long-standing complaint at FERC on how to deal with that issue, and we're hopeful that sooner than later FERC will address that issue, because that's really impacting the marketplace and rest of the state.
Message received. Margie. Ms. Phillips.
No, Margie.
Yeah. Usually I ask Margie not to ask questions, and here I am just putting myself into the...
No, excuse me. I am with Direct Energy, but I was asked to speak on behalf of RESA, which is the Retail Supplier Association. And not surprisingly, we did not have a uniform view. So anything I say that is wrong, it's for Direct, and anything right is for RESA. I think the most important thing when an LSE is coming in to provide a retail service is, can we hedge? That's the value that we add, is that we are able to use a large portfolio, go out to all the resources, physical and financial, hedge the risk, and then provide our customers the benefits from hedging. One of the things that does, while you can hedge in the forward markets, I would point out that, for example, hedging in PJM, while some of our companies feel that it's very doable, many of us feel it's a challenge, and that is because the actual capacity price in PJM changes daily. I don't know if you're aware of it, but there's actually a daily zonal factor that goes in. So every day the LSE's costs change. In addition, because it's forward and 3 years out, they have incremental auctions that impact the pricing. So the hedging in these forward markets is very challenging. The difference in NYISO is, and I have to get this in, is, Steve, I have to respond just real quick to his comments about the functionality. You've seen both in New England and PJM major overhauls. ISO New England just filed their performance-based. PJM is now claiming emergency and going to file something, and that is because there are flaws in the forward that you don't see in New York, because New York is seasonal, and that allows us to hedge, and we can hedge our obligations. They can be monthly or seasonal. And the other really critical piece is, in New York you can self-supply. And I would add that my former employer, Hess, built a power plant so that it could self-supply its capacity if it needed to. It was the ultimate hedge, if you will. That's what a power plant is, the ultimate hedge. In the other forward markets, the RTOs are procuring on behalf of us. So I can't do a physical hedge and turn around and give it to the RTO and say, this is what I want. I must take the clearing price as a LSE. Some of our LSEs are very comfortable with that and say they can hedge it. Many of us, frankly, I think it's fair to say that, and particularly Direct, much prefers the New York model, where I can self-supply. I can actually use physical assets to hedge, which in PJM you don't. You use, and New England you would probably use the financial markets as an LSE, because there's no incentive to the generator to go into a contract because it's going to be cleared by the RTO. So I would say the ability to hedge efficiently is probably the most important thing to us, and regulatory stability, because we enter into contracts, and every time regulators, whether it's you guys or New York or whomever enters in, it undermines what we thought we were bringing to the customer, and somebody's going to incur this cost. If we incur it then, somehow we'll find a way to push it through in the future, or otherwise the customer gets hit with the cost right away. So regulatory stability, like Gavin, is really critical to us.
So, Margie, that was really interesting. So when you say you're relatively happy with the hedging opportunities that come out of the NYISO market design, is that you mentioned the lack of a forward market, but are there other things that make NYISO more effective for hedging?
Yes, for one thing, it's actually a much more transparent market. I don't know why. I've tried to get this from my traders, and basically there's a couple things that NYSO does. One, they have their gold book, which predicts out a lot of information about generation. And from what I understand from my traders, and I'm a regulatory person, is that they are able to analyze, if you will, the data that's put out by New York and come very, very close to figuring out where the capacity is going to trade. Not only that, when they're wrong, they actually see where they went wrong given the data. When you look at the forward markets, the data is simply not transparent the way it is in New York. Now again, I want to add there are some RISA members who are very comfortable with the New England and PJM models. So I am speaking on behalf of those of us that think that New York perhaps provides more transparency and makes it easier for us to hedge.
Thank you. I want to turn to Ray Kinney from NYSEG and Rochester Gas and Electric.
Thank you. Certainly, I think we would concur with our colleagues with regards to stable market rules and transparent pricing. We're not convinced, and obviously, the utilities in New York, they've largely divested of supply assets, so we're not necessarily in the business of needing to build or procure those assets other than for service through the capacity contracts to our customers. However, we're not convinced that the very short-term nature of today's capacity markets are that conducive to incenting new investment in New York. Forward capacity markets may not be the panacea for all this, but we certainly think, and we commend the ISO for looking at forward capacity markets, that is something that we should at least be considering. We should be looking at looking to our neighbors to see how they're working, looking maybe for a slightly longer commitment period when a capacity contract under the NYSO markets are signed, instead of the 1-month procurement period that we have currently under the demand curve markets, effectively. As far as hedging, I think the one thing we have to be careful with in New York is we have retail access. So the customers you're serving can move on a relatively frequent basis. So there's definitely a need to balance that forward procurement and a longer procurement period with that recognition that there is retail access and loads are being served by different ESCOs and transmission owners over the course of time.
Thank you. And from the customer perspective, Mike Mager from Multiple Interveners.
Thank you. Good morning, everyone. For those of you who may not be familiar with Multiple Interveners, it's an association of 60 of New York's largest industrial, commercial, and institutional energy consumers. We have a somewhat unique perspective in terms of investment because we're the ones who ultimately pay for everything. And so in terms of making investment decisions, our members look at what the resulting prices are and what rates are, and they make their decisions whether to stay in New York or to move their business elsewhere. So obviously, prices is extremely important. We want capacity markets to ensure reliability, but we don't want to overpay for surplus capacity. So in looking at things, we see definite improvements that can be made, but from a big picture, taking a step back, we do think the NYSO's capacity markets have worked very well. We have added a significant amount of capacity in the state. It has been located where it's been needed the most, and New York has not suffered from inadequate capacity. So while there are definite improvements that can be made, and I'm sure we'll get to them, we think that the market is working relatively well. We have concerns about buyer side mitigation as serving as an impediment to new entry. We also are very concerned about forward capacity markets, where I disagree with my colleague. We don't want them. We've seen how they work in other regions and prefer not to go down that route. We thought it made sense when the NYSO examined forward capacity markets the first time. The second time they looked at it 4 years later, we kind of understood. We didn't know if it was necessary. The third time, barely a year later, we don't think it's necessary to go at this again. In terms of capacity markets and the state, we need to figure out a way to have what the state does work well with the capacity markets, and that's a very thorny issue. From the consumer standpoint, the worst possible outcome would be for the state to do something and then have it be mitigated, and have consumers essentially pay for it twice. Once on a retail level, and a second time not having it recognized in the wholesale markets. So we're very concerned about making sure that doesn't happen. And I'll stop here for now to give others a chance.
I definitely understand your point that if you have to pay for a resource and then it's not allowed to bid into the market because there's two different masters, I understand the point you made. Is there a countervailing point that if resources aren't mitigated and you had two different systems working in parallel, then someday when you needed the market to produce the reliability, do you worry at all that it will have been hurt? I mean, because that's something we worry about a lot, is if we don't have the proper mitigation rules, will the market still function, or are you paying a lot but you're not necessarily going to be able to count on the reliability that, I mean, I don't mean to be disputative or whatever, but I'm just interested in how you sort of factor in that kind of long-run reliability versus...
Well, look, you know, Gavin mentioned New York as being a strong state with an active commission. It's been that way since the NYSERDA started operations, and since then we have not had capacity problems. We have had adequate capacity. So to date, 15 years into the NYSERDA's operation, it has not been an impediment to ensuring that the lights stay on and that there's adequate capacity. You know, I think people can differ in terms of what extent mitigation is or is not needed, and you'll probably hear concerns from both sides of the fence on that one, and it's going to be up to you to strike the right balance.
Yeah. Absolutely. Well, that's why the panel's set up this way. Thank you. Next is Glenn Hake from the New York Power Authority.
Thank
Yet
you,
another unique institution in New York.
Yes, thank you, Chairwoman. I represent the Power Authority, but I've also worked with the Municipal Electric Utilities Association and the New York Association of Public Powers, Public Power, as well as LIPA, Long Island Power Authority, and I'm going to try and reflect their views in my comments. I guess from our view, the ability to have a fair opportunity to recover your costs is probably the primary concern for investment. And I think we tend to lose track, although I think Dr. Patton may have mentioned this, that the voluntary and mandatory auctions administered by the ISO are really just a part of the capacity market, and that there really is approximately 50% of the market that is in bilateral contracts. So for public power, it's really important that the ISO market rules complement and not impede that bilateral marketplace. But our concern is that the excessive buyer side mitigation rules that exist can cause significant impediments absent some exemptions that we think are required to the ability of self-supply public power entities to engage and manage their systems and through self-supply transactions, and importantly to the achievement of important public policy objectives. And we think that this is not a process that can be done in a piecemeal fashion. You know, about 2 years ago, the New York ISO came forward with a competitive entry exemption that was applicable only to merchant entrants. And at that time, NYPA raised the point that if you do a competitive entry exemption in isolation, it actually exacerbates the challenges faced by public power entities to achieve self-supply transactions and to achieve public policy goals because of the sort of first mover advantage that these have. And I'll get more into that. I don't want to dominate the time. But so we've maintained consistently that this needs to be done as a package of coordinated exemptions. And to your question, Chairwoman, clearly there's a tension between having an unfettered marketplace, which I think Dr. Patton just said doesn't necessarily procure all the attributes, products, and services that we need, and the bilateral contracts provide a greater opportunity to value, versus having exemptions that accommodate these types of things. And really what it has to be is a balancing of the interests, and there need to be limitations on these exemptions to ensure that we're not over-investing in public policy projects and so forth. So I guess I'll leave it there for my part.
I feel like this is like a cornucopia of issues that have been opened up, but between all of our questions, I'm sure we'll be able to pull on some of the threads, like 10 different metaphors in that sentence. But next is Robert Gurman from Pocono Manor Investors.
Thank you, Commissioner, and all of you commissioners. As an investor and a potential future investor, I'd like to make the point that formation of capital really starts sooner than most people have been addressing. And you don't just have price signals, however derived, and presto, capital forms around an investment generator, some form of new capacity. And especially if the signal itself and that methodology is source agnostic, because you need, therefore, to give developers and the development capital time to put together the most cost-competitive response to the price signal. And I just don't think that this is addressed enough. This is also the highest risk capital, and is not necessarily institutional capital, but it is usually the most innovative capital, and that's very important in the assessment and addressing the market's capacity needs. So I think that more visibility earlier on, a queue is a very good idea, certainly without giving any guarantees that a certain capacity will be required in the future, but again, to give that development capital time to work and get some ideas into the queue.
So do you mean more of a forward market, or is there something else you mean by more visibility early on?
Well, it's both a forward market, but it is, in fact, earlier on as the Planning Commission, as the planning entities are developing in more concept. Now, speaking of the forward markets, I think it is also important to distinguish or to my perspective is that the forward markets for new capacity, particularly large installations, you definitely need a minimum of 5 to 7 years, but perhaps longer in less robust markets of price and hopefully contractual certainty. Otherwise, you can't attract either debt or equity in the new build, new investment thesis.
So is that happening now through a combination of the relatively short-term capacity market and the bilateral contract?
I think it's the bilateral contracts. And I'll just make one more distinction in that being in the market myself, New York City Zone J is very hot in terms of both the investor and lender community. And I would just like to make the distinction, which is obvious, but it needs to be said, that, for example, we've been told for our plant that we have 18 months until our contract runs off, and that's providing good visibility to the future of the markets. That's only good because it's an existing asset. The 18-month forward visibility would not be enough to get new capacity financed and built.
I want to ask colleagues if they want to pick up the next question.
Sure. So, not sure where to start.
Need a microphone.
Well, I'll start with the microphone. Thank you. So let me start actually going back, Margie, to your comment. When you're hedging forward, what period are you looking at?
Most of us hedge forward only about 3 years. For one thing, the industry's really changed over the couple of years, and the collateral requirements are so high and can in fact be a barrier to longer term contracting The gas markets typically contract out up to 5 years. The electric markets are typically about 3 years. And there's a bunch of reasons why that's so as well. In addition to collateral, you have regulatory stability, which is unheard of in our industry, and therefore there's a lot of risk. And that's pretty much defines the landscape.
Okay. And then, Michael, because this is where I think there's a huge conundrum that I'm struggling with, and I think we need to think through. From when you're purchasing the MI customers, when you were actually, when we were chatting about this last April, you said about the same period. When you're purchasing forward, you're looking at 3 to 5.
Yeah, I would say from the large consumers, to the extent they hedge, they're actually probably even a little shorter in duration, more like 1 to 3, the majority.
And then, so if I can then sort of try to piece all this together, what I'm hearing then is on the investor side, probably 5 to 10-year minimum on some sort of offtake, and then on the hedging side. So how do we put all this together?
Can I?
Yeah, I knew you would have an answer.
I think the point is people don't realize, they look at load and think that, oh, I'm not making an investment the way a generator is. Well, it's true, I'm not making a one-shot, hundreds of millions of dollars investments. But I have to tell you that our collective companies, it's very expensive to acquire customers. And we spend a lot of time and money and resources. And we are not in this game for 3 years. We are in this game for long term. And, excuse me, and our views of the market are long term. And if I can speak for Direct, formerly Hess, when we made the BEC investment, in fact, I even had this discussion with Commissioner LaFleur earlier on, we weren't looking at a 1 year or a 6 month strip or 10. This is a 20, 30-year asset. When the investment decisions are made, we were looking that we want to serve load forever, and what do we see ultimately as our forward projections over 20, 30 years. What is very important, I think, from both in the long-term and short-term investor is market integrity and the opportunity for everybody to earn a fair return, not a guarantee. And for LSEs, we want price transparency, and we are here for the long term, and we'll continue to buy the generation. We have to, or we go out of business. But I think we tend to speak in short term when all of us really have longer term views.
Yeah, I guess I just want to add, I think stability is very important when we talk about what investors may or may not need. I mean, to the extent we have a capacity market that's working, we know the demand curves, how they work. We know that prices are going to go up when things get short, and prices are going to come back down when we go long. We know the process for updating the demand curve. Maybe we can talk about whether it should be 4 or 5 years instead of 3, and that might be a helpful improvement. I get nervous when there's discussion about price or revenue certainty for generators or developers, because to me that doesn't sound like a competitive market. It sounds more like the risk of the generation is being shifted back from the developer to the customers. That we're going to have to provide price certainty for someone for 7, 10 years or something, regardless of new technology, of how the market is working, the supply and demand situation. And so that gets, as a consumer, that gets me very nervous. None of our members who sell in all sorts of industries and manufacture products of numerous types, none of them have revenue certainty going, 6 months out, let alone years.
I'd like to jump in here.
I think everybody does. I'm glad I asked a relevant question.
Well, I appreciate Mike's perspective, but just a little case history here. When FERC acted on the lower Hudson Valley zone, it took a lot of political pressure to stand up to the pressures here in New York. I appreciate that, and you should be commended for that. That sent a market signal. Nobody asked for guarantees. Nobody asked for certainty. Folks came into the marketplace, evidenced by Bowline, his commitment yesterday, and Dan Scammer. But let's back up a little bit and talk about in-city mitigation. When FERC corrected that market impediment, NRG brought back units in New York City. As Margie mentioned, Bayonne Energy Center was located in the city. And just recently, U.S. Power Gen announced that they're bringing back a facility. And if we didn't have those facilities brought back into the city, I'm not sure what we would have been dealing with the polar vortex. So, I respect Mike's opinion in many ways, but the guarantees, we're not looking for guarantees. What we're looking for is fairness and markets being administered transparently. That's what we're looking for.
But let me just follow up, though, because what I'm hearing is a real challenge. I mean, on one hand, you have folks who are saying, I'm willing to put money into putting in these plants. And we're seeing this with the same company you're mentioning, NRG, who's obviously came to us with an RSS requirement to keep a plant open, and saying, I can't obviously operate at a loss, and in certain circumstances, and I'm not going to necessarily build new plant on the basis of a forward price curve unless I have a counterparty that I can actually work with. And it would just strike me that when we're talking about these issues, what I'm hearing is a consistency. There needs to be a confidence that the price on a forward basis is transparent enough that the person buying the power, as well as the person investing in the resource, knows that they're striking a fair deal. And that doesn't necessarily require a forward market as opposed to forward price information. And that's sort of what I'm at least hearing from it. And I would just be curious as if you guys would agree with that you don't need a 5-year market fixed price as opposed to knowing 5 years out if I'm going to price it at this level, I'm going to be in market. But if you think you're going to be mitigated, that's going to chill your willingness to actually do that.
I'm also interested just to clarify, when we talk about forward price certainty, the ISO showed a chart for a peaker or turbine where they get 70% of their revenue through the capacity market. But I thought for most of the combined cycle and so forth, the vast majority of their revenue was from the real-time energy market without price certainty. And the part that a capacity market was locking in was a considerably smaller part of the revenue, because most of the money comes from the energy market, which has a transparency but not forwardness. But I'm interested in if I'm correct there, because I think we're muddling capacity, energy, and other revenue streams.
I mean, obviously, we need to have a capacity market that's granular and sends the right price signals for resource adequacy. And if we have local reliability issues, we need to make sure that there's transmission built. Maybe the answer isn't the generation unit all the time, but if we don't have adequate transmission, we're forced into some of the positions that we're forced into today. It gets to Commissioner Muller's point. As an organization, we're not unified on a position on a forward capacity market. We're anxious to see what the report is from the analysis group, and we commend the ISO for looking at it. But we do believe a look forward in the marketplace is important. A 3-year to 7-year look is something that we've debated as an association internally, but we don't have a unified position on what that forward market would look like.
But what percentage of your revenue comes from that?
About 20%.
Okay.
My understanding is that is upside down between the city and upstate. Our two states here that we deal with. In New York City, a vast majority of the income, I think the one chart that the ISO showed up, comes actually from the capacity market. Upstate, it's just the opposite.
So we are in a multi-state ISO.
Yes, you are.
But I think it's very important to recognize that these markets were designed such that all of your revenues come from the combination of energy, ancillary services, and capacity. And anything we do, we have to recognize the interaction of those three distinct revenue streams.
Commissioner LaFleur, this is Steve. Just want to comment, it's not really upstate or downstate, it's whether you're a peaking type of unit that just runs a few hours, then obviously you're not going to get many energy revenues. You're going to get most of your revenues from the capacity market, and most of the peaking capacity is downstate, which is where we have needed it.
I'm going to ask my colleagues if they have questions. I know some folks have to leave early. I don't want to. Okay. We'll keep going. Yes.
I just have a quick question, and anyone can really answer it. Is under REV, we're beginning a comprehensive regulatory overview and new scheme, and primarily the focus has been from some folks on the creation of the DSPP or DSP. Does your analysis change on a forward capacity market based on who who is the DSPP, and especially with the ESCOs. Does that change because now there's a new regulatory scheme as to the DSP?
First of all, I know Steve Wemple's participating tomorrow on behalf of RISA, and I don't want to steal any, I don't really want to comment on REV, except to say what was very interesting in RISA is when we did go to discuss this, it turns out that the group had never taken a position on the wholesale capacity structure in NISO. So if that adds any clarity, meaning that I think we tend to view it as two separate issues, but I'm sure Steve, hearing this question, will be ready to address it more thoroughly tomorrow.
Okay, thanks. And I, I think the focus for me is also on looking at it from the perspective of how is what we're doing in REV affecting the wholesale market indirectly or directly, intentionally or not, and what does that do?
I'm comfortable speaking for direct if you want to hear it. I'm not comfortable speaking for RISA. I think our views are, we think competition works. My company in particular is bringing a lot of innovative technologies to the forefront. We are interested in partnering with everybody, including utilities, but we're very concerned. We think the structure actually, as it exists currently, in terms of the wholesale market and going into it and providing some of the services, is a very valuable thing. And we are concerned about how it's ultimately structured so it would not hurt the competitive aspect of what we want to do, which isn't to say we wouldn't be interested in partnering, but we do think that New York, the seeds for competitive markets are already there. You don't necessarily need to be creating new entities to achieve those goals. But I think you'll hear a lot more about it from RISA tomorrow.
I guess my take on it is I don't think that there's necessarily any conflict. First, it does not change multiple interveners' position on forward capacity markets. I think, no surprise, I think David Patton identified a number of the concerns with forward capacity markets. I could speak more about them in terms of over-procurement, the price volatility, the higher prices, simply the sheer amount of resources of the NISO and stakeholders that would likely be diverted for years at an unknown cost to even design a new forward capacity market when the one we have is working just fine. In terms of REV, as I see it, the Commission's, one of its primary goals is to increase distributed energy resources at the retail level. And primarily, I hear of demand response and distributed generation as two of the most common DERs. And I think that both of those resources can exist perfectly fine within the existing wholesale market construct. The NISO is already examining how it can accommodate having a lot more DERs on the system. To its credit, the NISO's been on top of this from the very beginning, and so I don't think it presents any reliability issues whatsoever. I don't see how increasing demand response at the retail level is in any way inconsistent with a market. I think markets need both supply and demand, so having more demand response is perfectly appropriate. I don't see anything wrong with distributed generation. I guess the only caution, or the only way that I could see there being a conflict, I think, is if DERs are kind of subsidized in a way, that are built where maybe they're not economic, and that could have subsequent impacts on wholesale markets. But simply facilitating, removing barriers, accommodating DERs, I think is wholly consistent with the existing wholesale market.
If I could jump in, last year the average load was about 19,000 megawatts, and the peak was around 34,000, and that trend has been diverging, so that the peak and the differential has been growing. And I take it that one of the objectives of the REV proceeding is to shrink that differential so that we have a more efficient system and less resources that we have to pay for sitting around idle for many hours. If we're successful in doing that over time, that's going to have significant implications for the amount of missing money that is needed in the capacity market and for energy pricing, because we're going to have a flatter curve but a broader curve. So I think, those are a couple of the challenges, and the challenges to make sure that these two new types of resources that are going to come whether we want them or not, and by the way, I think we do want them, is to make sure that they are accommodated in such a way that we maintain system reliability and that we do justice to the competitive market outcomes. And if I could just take a second to go back, because Public Power didn't really get an opportunity to weigh in on the forward capacity market. We too are interested in seeing and keeping an open mind on the forward capacity market report that the ISO is presenting. But we're not convinced that a 1-year fixed price 3 years out is superior to 3 years worth of demand curves, and we would support the idea of moving to 4 or 5 years worth of demand curves for a number of reasons. But in our view, neither one really is going to be sufficient to fully support project financing. And we've seen that with all of the resource additions virtually, other than Margie's Hess project and maybe one other, that have come along since the ISO has started. They've all relied on bilateral contracts, usually through competitive procurement proceedings, and that's fully consistent with competition and something that, again, the market rules need to facilitate.
I think Commissioner Bay had a question.
First, I'd like to thank all the panelists for appearing before us today. I found your comments to be very helpful. One thing that's very interesting to me is that even though you represent very different constituencies, there seems to be a general agreement that the NISO capacity market is working, that there seems to be a general level of satisfaction with it. And let me know if that's not so, but the one question I have for you is, and this has been raised by some of you, but not by others perhaps, is there anything that you would change with respect to their capacity market, or would you basically keep it the way it is now?
I think there's certainly, in any market, there's always opportunities for improvement. Fuel certainty, I think, is one thing that we continue to look at. The ISO has a process where they're having those discussions right now, but certainly fuel certainty is one aspect that needs some consideration. I think Dr. Patton, when he was giving his presentation, touched on a very important piece with regards to the lower Hudson Valley capacity zone and any of the smaller capacity zones. And that is one where he's, I think, suggested that we need a way to price in the value of transmission in aiding this. One of the things in the NISO market overall today is there's really not good price signals and market-based driven transmission investment. You haven't seen it. At this point, I think we need to examine the overall planning process and the capacity market process and look at putting both market-based transmission and maybe regulated transmission on an even keel with market-based supply solutions. And this is, I think, something that we've recommended more discussion on. The ISO is undertaking this. I think Dr. Patton has recognized that there is an opportunity here where we're missing a project, a process. We've put in place a lower Hudson Valley capacity zone with really no vehicle at this point to drive price convergence in the absence of that congestion, or when a new transmission line or transmission projects would remove that congestion, and I think that's a key piece. To Commissioner Berman's question on REV, I think it presents a golden opportunity here to bridge the part of the system that the NISO looks at with the part of the system that's below that, and can bring some market-based solutions to that piece of the system and kind of meld those two things.
Jumping into the capacity market changes, I know we've repeated ourselves up here about looking forward. We still think that we should look forward and have that debate as it comes. But I think the biggest issue for us in the capacity market is mitigation rules, dealing with uneconomic entry and uneconomic retention. I think that's the 800-pound gorilla in the room as it relates to New York's capacity markets. And I don't want to beat a dead horse or infringe on any ex parte issues, but that is a big issue for New York's capacity market. We also think exemptions in the market should be few and clear. They're awful tough to administer and police, make sure they're done properly. Obviously, in high demand time, we need certainty in the market, in energy markets and ancillary services, and setting the right price signals so the resources are available. And to complement Ray's comment, I think planning needs to be done better. I think we do an okay job at it, but I think better coordination amongst the PSC, the FERC, the ISO on coordinating long-term needs and planning would be worthwhile.
Commissioner Bay, from the public power sector, we share Gravin's view that the mitigation rules are the biggest issue that we'd like to change, but I think in a slightly different fashion. I should be upfront that NYPA is one of the appellants in the pending litigation on the new capacity zone, so I won't belabor this, but that conversation is often couched in terms of price convergence being the only issue in the case. And really, from our perspective, a bigger issue is that when the upgrades are made through the Energy Highway Initiative that render that constrained region no longer constrained, then the justification for having mitigation in that region evaporates. And at that point, load in that region can be served by lower priced resources outside the region and should be able to do so. They shouldn't be saddled with what would become artificially elevated pricing. And there's really no economic justification, because there's no longer a market concentration problem, to limiting, to applying mitigation to resources that would locate in that region. And I think that's an important thing that the Commission should consider. There's one other mitigation item that I think is very important and I'd like to raise for the Commission. We believe that there's a fundamental inconsistency in the way transmission is treated versus generation and demand response that's effective in these market rules. Under Order 1000, the Commission has wisely created a cooperative process between state and federal entities. When the Public Service Commission finds a transmission need that's driving public policy requirement that's driving new transmission, then the ISO is charged with looking at all the various sources, whether it be transmission, generation, or demand response, to see which is the most cost-effective and efficient solution for that need. Now, if a transmission solution is the identified best choice, it's able to get a guaranteed cost recovery through the NYSO tariff. But if a generation resource is the most efficient solution, and it happens to be located in a mitigated region, it faces the specter of non-cost recovery, because that public policy transmission need may not be accompanied by a resource adequacy shortage in the region. So you can have the most cost-effective solution stymied by virtue of not having a public policy exemption in the mitigation rules, and we think that's critically important.
On behalf of multiple interveners, I would identify 5 improvements that I think we can do to the capacity markets, which I do agree are working relatively well. And I won't belabor some of them that have already been mentioned. One would be to lengthen the demand curve reset process from 3 years to either 4 or 5 years. I think the process is appropriately comprehensive, because it's a very difficult, fact-intensive process. But when it was created on a 3-year cycle, we didn't imagine that it would take us 2+ years every time to get through it. I think having a longer breather between reset processes would be helpful. I think there should be a greater link between the performance during peak periods and compensation in the capacity market. I think the NYSO is already looking at that, but I'd like to just give you an example of specifically what I'm referring to. In New York, the run-of-river hydro projects get paid capacity payments based on their performance during the 20 highest peak hours for the last 5 capability years. Similarly, intermittent facilities such as wind and solar receive capacity payments based on their performance during summer peak hours in the afternoon during the months of June, July, and August. Demand response similarly receives their capacity payments based on their best 20 hours during the NYSO's 40 highest peak periods. In contrast, kind of traditional generation is based on 6 12-month rolling periods, which encompass an 18-month period. So basically, if a typical generator is out for 200 hours in a year, they're going to receive the same capacity payments irrespective of whether those outages occur during a low usage peak, shoulder period, or happen during the peak periods. And we think that can be improved so that there's a greater link between compensation and performance during peak periods. The third would be, I've already mentioned this, that we think the fireside mitigation is too intrusive. We believe that we understand the purpose to be to prevent inappropriate exercises of market power, not to guarantee revenues or create barriers to new entry. And I think some of the exemptions that we would support are competitive entry, exemption for merchant projects, projects needed to maintain reliability, and intermittent renewables, which are not capable of exercising market power. I think there needs to be a little better coordination between capacity markets and energy markets in terms of, for instance, the new capacity zone that was approved includes the lower Hudson Valley and New York City, but not Long Island, notwithstanding the fact that Long Island both receives and provides assistance to the lower Hudson Valley. Yet at the same time, the NYSO is working on its scarcity pricing and looking at a new southeastern New York reserves region, which includes the lower Hudson Valley, New York City, and Long Island, because of the assistance that Long Island provides there. So there seems to be a disconnect on that issue. And then finally, I think it was already mentioned, but we would like to see processes in place for the elimination of capacity zones that are no longer needed. Right now, the FERC has approved a test where basically if you fail a deliverability test, boom, a new capacity zone is created. And to the extent that new transmission is added and the constraint is eliminated entirely, it makes sense to also eliminate the zone. Thank you.
If I could just mention, I would just make a couple of points to Commissioner Bay's question. One is I agree with Gavin that the mitigation rules have to be more consistent and simplified, but also in terms of shifting the demand curve and flattening it, and the missing money issue, that's very important for investors, and I certainly see the public policy issues with flattening the curve and making a more efficient system, but the missing money is an important economic feature for investors. So I'll just leave it at that.
If I could, since I haven't spoken, shockingly, I wanted to get back to something Ray said, and this goes directly to Commissioner Berman's issue. There are already entities looking at the distribution level to bring the kind of creative, innovative solutions, and that would be the point, which is we just want to make sure that whatever is done in the REV proceeding doesn't undermine what is already, some of us in that space are already trying to achieve. So that's that. Commissioner Bay, one thing that I think our group feels about, we understand that LHV was 7 years in the making. However, we couldn't price it because we had to wait for the new demand curve to come in, and then LHV came and it was 6 months, and as I mentioned, some of our contracts go out 3 years. So our plea would be a longer lead time. It's not that we oppose getting the market signals right, but it's always our mantra that the more notice, the longer lead time we have, the better off we are. This is a kind of interesting conundrum, and we were both the beneficiary of it, and now we're not. Unlike in the other markets, the New York spot market for capacity actually trades every day, and it moves. And I give this by way of example. I went to the bathroom once, and my trader, it was something in a New York meeting, and I got back, and my trader sends me this note, "What is going on? The markets are going crazy." And I had to call everybody and text them who were at the meeting to find out what little kernel of whatever had just been said at this meeting that the markets reacted to. That's a very good thing, but you have to be very careful, so it's very important that any kind of information is transparent and available to everybody, sort of on an equal playing field. And what is a little challenging is we're agnostic on the mitigation, we're not going to comment, but what is interesting is the units that are getting mitigated have an inside track on what the clearing price for capacity is going to be. And we don't know how you handle that. but you do know, because you've been told your unit passes or doesn't pass, and then you know where it's, and I, believe me, we were the lucky beneficiaries one year with my former company, but it is a challenge that frankly all of the organized markets make when they're mitigating units. That unit owner has a clear inside track on what the price is likely to be. Don't know how you fix it. In an ideal world, we would. And then finally, I would say, turn your question around and say, how can we continue to improve energy markets? That's really where the focus should be. Would suggest that New York's focus on shortage and scarcity should be very, very helpful. It should incent generators without penalties to want to be there when the price is right. And frankly, from an LSE perspective, the more costs we can get into LMP and the energy markets, the better off, better able we are to hedge for our customers and actually bring real benefits. Because energy markets are really where the game was supposed to be, and that's where we have the most tools to actually help customers, manage their energy needs most efficiently.
This is such a rich broth, I barely even know where to, which nugget to sort of ladle up and start talking about. I always say that we're in a complex ecosystem in our energy world, and this really demonstrates it, because I had talked about how you make investment decisions, but we have the generation investment decisions, transmission investment decisions on a different time scale, vastly different time scales sometimes, and then targeted environmental programs that are being layered in, and then the people who are on the retail side trying to make sense of all that. And most of the specific questions, I feel like we're like at graduate school level, and all the questions I brought were like, what do you think of a forward capacity market? Well, I think that's been answered by everyone more than once. And I guess I strongly take Margie's point that we can't look at capacity markets in isolation. And in fact, the Commission has started, with our wonderful staff, some of whom are here, a major effort of looking at price formation in the energy markets, because we know, other than New York City, that's where most of the money comes from. And if we don't get the price formation right in the energy markets, that also strongly influences investment decisions. But I think on the capacity markets, although they are usually a smaller percentage, I think are playing in, I thought, a critical role in getting the investment we need for reliability. And I'm concerned if we're not sharp in what we want them to do, we won't have a prayer of long-term sustaining a system where they do that. And I seem to hear different people wanting different things out of the markets. And that's in terms of whether you want, a long-term price signal or just a short-term price signal that you can build a contract around, a price unalloyed by any other money coming in that's not reflected, versus let 1,000 flowers bloom and we'll just let this do what it does. And it feels like there's just quite a lot of different expectations being layered on, and I just really want to distill it in my own mind. But I think if we're going to have a capacity market, and it's quite a lot of money going through it, having a clarity of that it's for long-term investment, whether it's a long-term market or not, it's for long-term investment, seems to me to be what's most critical. And some of the other innovative things we're doing, I think maybe are not in the capacity market. It's more of a comment than a question, but that's just what was coming to me as I was listening to the prism being turned so many different ways.
Sure. I mean, again, I think it's great discussion. And I think bringing it back to recognizing the capacity market is just one piece of it. The other, I think, piece of this, which is certainly, foremost in our mind and thinking about some of these questions, is that what we're really talking about is driving market efficiency and system efficiency. And one of the points that it seems to be lost in this last bit of discussion, which is that we did the capacity markets in the first place, as the ISO points out, to get investment in where needed and when needed, and get investment out when needed or when no longer needed. And I think that part of this discussion of how moving forward, and I know we're going to talk about this more in the afternoon, the retail markets and the wholesale markets need to work together, is as I felt that there was an impairment in the retail markets in getting the consumers to be able to act in a way so that they could reduce their consumption when economic to do so that we could either take investment or retire generation that was no longer needed, or avoid making investments in resources that are only required a few hours of the year. I mean, so if that's true, and if in fact we can reduce our reliance on generation resources that are largely just there for peaking requirements, and then start focusing on the missing money issues associated with the energy market, I think that we can drive the markets in a way that will meet both the needs of the investors and the generators, as well as the consumers, because we're going to be driving efficiency. And my concern as we move this is that, as I was listening, is it's not so much the attracting the new investment that may be sort of the thing that New York is struggling with, but actually the retention of certain investments that actually should be there, but are not getting the money they need. And I'm concerned that that's more of a, not concerned, but I want to make sure that when we're identifying the problem correctly, and then we're fixing the right problem. And if the problem is that we need to think about the energy market, we need to be pricing reliability better, let's focus on that rather than thinking this is just a capacity issue.
Could I respond to that?
Yes.
Yeah, I think those are very important points. And you know, it seems like I've heard some parties complain that because we have RSSA agreements, that indicates a failing of the market. But I think we need to keep in mind that really the capacity market is designed to assure resource adequacy. And there are a number of attributes, products, and services that the capacity market some have suggested should be called upon to procure. And from public policy's perspective, we think that's not the efficient way to proceed. If if public policy determines that we want to ensure we have access to non or low carbon producing resources, or that we need a stable fuel supply, we think that a targeted ancillary services agreement, a targeted ancillary services market mechanism is the more efficient way to go about that. And so, you know, that's one point I'd like to make. The second point really is that as we try to differentiate the capacity market into greater products and services and ask it to do more and more things, if we were to go that route, and as we geographically bifurcate it into more and more resources, more and more segments, we increase the potential for the exercise of market power. You know, we increase the need for mitigation, and we increase the complexity substantially. And so those are all things that I think we really want to try to avoid. And again, I keep getting back to beating the dead horse that I think it was Dr. Patton who said, you know, bilateral contracts really give you the ability to value each resource in it and the attributes, products, and services that it provides uniquely as compared to other resources. So we need to make sure the market rules facilitate rather than block those.
You know, from the generator perspective, we recognize the state has very strong public policy goals, and we support many, if not all of them. We're big supporters of the RGGI program and looking for national policy on RGGI. We recognize these things are going to happen from time to time, but we think, you know, the way to best address those issues and those goals that a governor may have is not through a capacity market, because exactly what Glenn said, it's about resource adequacy, but it should be somewhere in the marketplace, seeing what's the best market investment for the consumer. We do not want to keep putting more costs on consumer bills. New York has a strong liking to want to do that, and what we want to do is look at a competitive market model to address those public policy goals. It should not be in the capacity market as a way to attract investment.
So if I could pick up on this, because Gavin, I think it's an important point. So if we say that the capacity market itself should be technology agnostic, but there needs to be mechanisms in order for different resources with different attributes to be invested in and built, then that does get back to an issue is that if those resources then become mitigated, our ability to achieve that goal becomes more and more expensive. And so I think that's where we need to get back to, is that if we're going to mitigate on the buyer side, it has to be for economic reasons. But if there are other public policy reasons that we need to achieve, which you just said you understand have to be occurred, we have to be also mindful of finding ways to do this at the lowest possible expense to consumers. Otherwise, consumers are not going to get the confidence in the markets. And I hate to argue with you, but that's, it gets down to, not only investor confidence, but consumers' confidence. And if they think that markets are too expensive, we're going to find, they're going to look for ways to get to certain policy objectives short of markets, which I don't think any of us want to have.
Well, just to push back a little bit, as I indicated at the beginning, and wholesale rates are at an all-time, I think, low over the last 15 years. There's a small percentage of folks' electricity bills. Our association wants to...
But before you go there, there's one clarification I think we always have to make. A lot of that is because a lot of our RPS requirements are placed on the delivery portion of the bill, not the commodity.
But I understand.
And so I think that tends to be an artifice on how we look at what the wholesale markets have done versus the retail markets.
I guess my point is that we don't think regulators have to pick winners and losers.
I agree.
And to me, it sounds like to get to that public policy goal, there's a position to advocate for that type of decision. We think the marketplace can do that. We've stepped up time and time again, and we want to continue to do that. But we don't think regulators should be determining what's best for the marketplace. Ultimately, you get to the lowest rate and the lowest cost for consumers through the private industry.
I have to apologize. I'm going to have to leave here shortly. I have a commitment, pre-existing commitment, so I'll need to sneak out. But just make a couple observations, and folks don't necessarily need to respond, but please feel free to. On the issue of the Lower Hudson Valley, because it's come up a number of times, to me, I would just make the observation that issue and the consternation that came about because of it is probably related as much to anything of this mismatch in timing. I hear and understand the concerns of folks in New York who say we've got a plan for the next 3 years, 5 years out, whatever that timing frame is. But from a FERC standpoint, we're concerned about reliability next summer. And the engineering studies and the analysis was uncontroverted in that particular case. And the issue of Long Island was brought up, if I remember off the top of my head. I mean, FERC analyzed that issue. NISO analyzed that type of issue, and we looked at import capabilities, and the numbers just weren't there. So the issue was really this, for FERC's standpoint, reliability next summer, and I understand from New York's standpoint, trying to plan for the energy future 3 to 5 years out. So that's just an observation. My ongoing hope is that we can try to find a way to thread the needle. I don't know what that exactly looks like moving forward, but to explore options that maybe answer that question. Is there a way to continue to have an operating, functional, wholesale energy market that ensures that those generators who have had a substantial burden placed upon them because they're unbundled, they don't have a captive ratepayer to support them anymore, that they have a viable path forward in a FERC jurisdictional market by virtue of the Federal Power Act itself. But that to the degree a state wishes to continue to plan, are there ways for them to be able to do that doesn't undermine the integrity of that market, perhaps achieves public policy outcomes that they think are things that they want to do, but understanding that there may be out-of-market costs that come along with that, and to the degree they're willing to accept that, that may be an acceptable outcome. So it's a big task, but as I said before, we've just scratched the surface. With that, I've looked in vain for a discreet way that I can sneak out of this auditorium. And it looks to me like the only way I can do it is right behind the entire dais here, so I'll have to do that. But I apologize for that. I do have a couple of advisors
You're
here.
on Broadway, and you're just running out to the audience.
Jazz hands.
Well, before you sneak away, I guess since you brought up the lower Hudson Valley, I mean, I think it's important to note that from the consumer perspective, that we saw a more than doubling of capacity prices, essentially overnight. And that had significant impacts on consumers, both residential and businesses. And that impacts their decisions too, as well as their confidence in the markets. Perhaps, reliability, I believe, would have been maintained had we done something differently, perhaps a phase-in. So I guess I disagree that we have to go to great lengths. I think you mentioned that unbundling was imposed on the generators, and I don't look at it that way, because in New York, either the generators decided to build or they willingly purchased existing generating plants when we were doing unbundling. So in that case, they knew full well what they were buying. And so I know that there's a lot of opinions on that, and I guess you invited a response, so I felt compelled to give one.
Yeah, if I could jump in, your comment raised a different issue in my mind, and that is, we've got a very short-term market here in New York, 6 months at the longest, and while the public power sector is agnostic on the benefits of a forward capacity market, one of the benefits is that you get a much longer notice of retirements and an ability to plan the system to either add transmission to accommodate the loss of a centrally located resource, or add generation or demand response. And we're not convinced, however, that you need to move to a forward capacity market to get the benefits of that. And we think that in the stakeholder process, one of the things we should be considering is whether we can accommodate or implement a longer notice requirement in New York State that would give us the opportunity to respond, give the market and or the regulated entities the opportunity to respond to these forecastable changes. Clearly, the generators are able to make plans 3 years out because they do so, our neighbors to the east and the west. And so why not in New York? And just as an added benefit, that would reduce the need for any reliability supply services agreements.
Just as a quick, I was just going to say, just as a quick response to that, not to be argumentative, but sitting in a FERC commissioner spot, when you have engineers who are telling you this is a problem. I understand all those cost concerns. Having been a state regulator for 12 years, I understand them as well as anybody, because I had to pass along some of those. But you also come into it as an understanding in the chair that I sat in now, where you say, I know people are angry now about the potential cost impact that we're going to have in the short term, but if there's a reliability event next summer, they're going to be even more angry at me at that point. And so it's always a balance that we as regulators take into consideration.
Commissioner Clark, and I appreciate that, and I just want to be clear on this. I think that, from the state's perspective, we recognize the importance of price signals and these kind of zonal signals where you see a reliability constraint. The challenge always becomes, though, is when you see a forward problem. And for example, in the situation of Lower Hudson Valley, there was not going to be necessarily a problem for this past summer, and then the question then becomes, how do we send the signal to get the investments, but not load costs on consumers before the investment can even be feasibly made? Because that's what feels to consumers like somebody's getting a windfall, but I'm not getting anything else in exchange. And I think if we could fix that and set these as forward signals so everybody knows, if you don't do it this is what's going to happen, then at least it gives people a fair opportunity to respond. And I think those are the types of things that would be great for us to dialogue around, because I don't think anyone wants to impose a cost on a consumer where there's no additional asset that can be made to respond to it. And So, but enough, because we've debated this, it's in front of the courts, but I think that's, I just wanted to make sure that we were all clear of that.
But I think there's a thread running through a lot of the discussion of the timescales on which decisions are made. How does transmission fit with generation? I mean, I think you could at least as easily make an argument we were too late with the zone than too early, and that it would have been smoother if it had been done at a different time scale. But there's just, we have so many different decision makers coming, and I don't mean just these two sets of decision makers, I mean all the decision makers in the markets at the retail and wholesale level coming at things with different time frames and what they're looking at. And I think what we're going to talk about this afternoon potentially has the, with all the upside, the potential to make it even more complicated in terms of those different vectors driving on what happens.
Oh, go ahead, Gary. No, I just wanted to take this bit back generically again, get us out of the lower Hudson Valley. Two phrases I've heard a lot about from you folks is regulatory certainty, and we also talked about public policy objectives. And on the face of it, those two conflict with each other, because when there's public policy objectives, that means somebody wants to take an action to make something different happen than might have happened normally through the workings of the marketplace. Regulatory certainty is don't change the rules on me 7 years into my 20-year investment because you just blew the investment out of the water.
Not certainty, stability.
Okay, let's...
We are okay with markets evolving. That's what they've done. What we're not okay with is when we make existing contracts, and as I've said, ours are not even that long term. If you do have a social policy, at least give us some notice. Yeah. That's really, so at least from our perspective, it's not certainty, it's stability.
Okay.
So that we can, you know, when you're going to make a major change, we can price it, and then we can provide the value that we do. It's not that we ask you to never, you know, to keep the market static.
Wasn't bad. I almost got halfway through my question before my...
I just want to say I totally agree with Margie on that. I mean,
Not just me.
Yeah, no, I mean, I've been doing this for 25 years, and I've never experienced 2 years of regulatory stability or certainty. I mean, this market is constantly changing.
Well, the market changes, but also the rules change. And renewable portfolio standards have been passed by 37 states. We've all learned to live with them. It's a market. It's outside the market, but everybody's learned to live with renewable portfolio standards. If you're in the automobile industry, you don't get to build whatever car you want to. You've got to meet CAFE standards for your fleet. If you build refrigerators, you've got to meet efficiency standards. Those are all public policy objectives layered onto markets. And I think Margie half answered the question that I was going to ask is, how can we achieve simultaneously both these goals? Because states are going to want to achieve public policy objectives. We are never going to blindly close our eyes and look 5 years later and hope that the markets all work exactly like we hope they were intended to. We're going to keep our eyes on them. That's the regulatory, both of it, the Fed and the state's job.
I mean, I think the two responses would be, one, to try to be sensitive and signal change as comfortably in advance as possible, but also recognize that regulatory risk or change is a risk that's borne by absolutely every segment of the market, consumers as well as generators. I mean, no one invests in the market thinking it's going to be completely static. Everyone assumes that risk, and so it's unavoidable, but also it impacts everyone, not just owners of generation or owners of transmission. It equally impacts consumers as well, and so it's unavoidable. I think just regulators have to be sympathetic to the impacts of their decisions on all constituents, and wherever possible try to signal change as far in advance as reasonably possible.
Gary, you and I have had this conversation back and forth for years. If the state of New York has a goal, fine, pay for it. But don't put that goal and make it part of the marketplace that will disenfranchise other folks that are trying to compete and make those investments.
But isn't the RPS exactly that?
Well, it is and it isn't. I mean, you're stifling, when I'm talking about uneconomic retention of units and how it's handling capacity prices, I just think public policy goals should be outside of the marketplace, because when you talk about the need for certainty in building things, you can't have that uncertainty in the marketplace.
Can I just jump in on the dialogue between yourself and Michael? Everyone knows, and I think Cheryl just mentioned before, there are so many stakeholders. Nothing that we ever do gets done overnight. It takes forever. In fact, sometimes it takes too long. So I think, you know, not only is this technical conference extremely important, but to, again, communication and keeping, you know, our doors are always open. Not a lot of people who make complaints often come through those doors. We hear it later on. So I think that it's really important, you know, if you have a stake in this, that you have to communicate before or while we're thinking of something is extremely important, because we do want to know.
Can I tell you the challenge of that? Because I'm actually... Let's take a hypothetical creation of a new zone that creates costs, and I'm going into the market. I can do one of two things. I see LHV coming. I see there's a filing at FERC that's changing the demand curve that's going to raise the price. I can add that to, and then my customer says, what are you doing? That's not in there. That hasn't passed yet. You don't know that FERC's going to approve it. You don't know they're going to approve the demand curve. You don't know they're going to approve. What are you doing? Okay, so I take it out. It happens. And then what happens is then I go to the customer and say, see, I was right. You know, I really was pricing it right. Now I'm either going to eat it and I'll get you later, or, you know, I have to pass it through. And I think that's what we're trying to say, is that there is a balance between, you're right, we are on notice and it is important to dialogue, but I just wanted to give you a sense of the challenge of trying to price something that's before one of you guys, when you are as unpredictable, you know, all of us would play lottery.
Is there a product on Earth where you do know what's going to happen in the next 3 years?
With my kids, I have an idea.
Yeah, good luck with that one.
Yeah, exactly.
I'm struggling to come up with a line from a Broadway musical to sum this up, but the song Orlando does come to mind, but maybe that's because it's freezing in here. The cliche about if we get the market rules right, the prices right, a lot of the issues related to capacity markets tend to go away. That's not the case with the lower Hudson Valley, but there's a lot to that. If we get the markets right, this discussion will be at least tampered down a bit. And that's why I commend what Chairman LaFleur is doing on our price formation efforts, which are pretty extensive. I commend what you're doing about trying to get the retail prices what I would consider right, which is real time. You look back on the polar vortex, one of the frustrating elements was, other than altruism, customers had no reason to cut back when we were at extremely high peak levels, and yet they paid for it eventually anyway. So it's not like the money didn't get spent. New Hampshire is looking at a 56% rate increase this week, I think. But I'm curious your thoughts on, just because they are related, how we get the pricing signals better in the energy markets, and if you have thoughts on it. And Margie, I know you do.
A couple things, and one thing that's really been interesting that we've been struggling with, and you've heard it a little bit, is this need for flexibility. Like I think at the RTO formation, it's very interesting to me that the RTOs were saying we don't want to price a 5-minute transient event, but maybe pricing it half an hour at scarcity is too long. And so what do you want? You want these flexible units. And then I think Glenn suggests, well, that should be in the ancillary markets. One of the things we're struggling with is, where do you compensate those units? The problem from an LSE perspective is the ancillary markets are not markets. They're not competitive. We can't hedge them. So the more you put in that, the less we can do for our customers. So that's a challenge that I don't know what you do. I can tell you that probably, this is really direct speaking, we think the cap on the energy market should come up. We think that we saw in the polar vortex that if you want those gas generators to be able to get the gas in real time, then you need to give them the confidence that they can go and get that. We're one of the largest gas deal marketers on the East Coast, and I can tell you that my guy said, had the customers come to us and said, we will pay you X, We had customers we could have flipped during that polar vortex that we didn't. But in all fairness, the generators had no confidence that they were going to be compensated. That was a big topic of discussion, and I know that Direct is in the minority about raising the cap, but again, we think that getting, and I'm not speaking for RISA, so the RISA guys can kill me later, but we do think getting the price right, that would go forward. The scarcity and shortage pricing that you're seeing should really help. I think some of the things you're seeing on gas-electric coordination, some of those should help, again, letting the generators, and New York already does this, actually, to their credit, letting generators bid their true gas costs both day ahead and real time. The other RTOs don't let them do it, so New York is kind of advanced. Yep. And so those are some of the areas that I see as being, that would really help the markets.
I agree with Margie before it goes down that
Okay. Thanks, Gavin.
You know, I think one of the key pieces, and she talked about, we can go out and get the fuel. If you're counting on someone for capacity, yet they don't have the fuel to back that up, you know, that's problematic. We're discussing fuel assurance policies here in New York, and I think that's a key element. I think Mike Mager mentioned earlier, counting on that capacity during the times when you really need it. How is their performance in close? Providing some type of operating capacity commitment and trading. If you're not there, you're going to have to buy out of that commitment. It's going to hit your capacity payment because you're not there when the system needs you. Those, I think, are market-based things that we can make changes on that provide for that certainty when we're in those situations.
I'll just make two comments. The first is, after kind of taking a shot at NISO for the third forward capacity market study, I feel inclined that I have to give them kudos on their energy markets, as well as the existing capacity market. I think the NISO's energy markets are working really well. I think they're some of the most, if not the most advanced in the country. I think to the extent you have a lot of New York ISO matters before you from time to time, I would wager that the vast majority of them are related to the capacity markets and not the energy markets. I think the energy markets are functioning very well. The other comment I would make is I guess at this time I'm disagreeing with Margie about lifting the $1,000 cap. The NISO had sought and received from you guys a waiver during the polar vortex to go beyond that cap if necessary. They did an extensive examination, and at no point did they find any bids or need to go beyond that cap. And so what we had was maybe a worst case scenario in terms of the polar vortex, certainly the worst winter conditions in decades, and exceeding the cap was never justified based on the facts and the evidence that the NISO examined. And so maybe at one point in the future it may be appropriate to lift the cap, but I don't think we've gotten to that point yet. And my concern from the consumer perspective, obviously, is that, you know, you lift the cap and then prices go, you know, beyond $1,000 a megawatt hour, and then you find out, no, maybe they shouldn't have been. At that point, it's too late to go back and fix the markets, and consumers can be hurt significantly in a very quick period of time. So that's my one, I guess, disagreement with Margie on that issue.
Can I say that we probably agree that while the prices should be raised, there needs to be market monitoring and oversight. It's not a free pass. The raising of the price is to give generators the confidence that if they have to do it, they don't have to sit around and wait for a waiver, which may or may not be granted. The idea is the mechanism is already in place. But we agree that you need strict oversight, and this is not intended to be a free-for-all to raise prices. It's really during peak stress system that you want, and you want to send the note that I will pay you anything to keep the lights on. And that's what raising the cap would be for those extreme situations.
And I know we're not going to go there, but that would apply equally on sending consumers the benefit of being able to reduce their consumption.
We're not supposed to mention the you-know-what here, but we are big fans of it.
Yeah. And now, Mike, I appreciate your perspective. It's good, but, you know, we are dealing with filings in PJM where 1,000 wasn't enough. And so it may not have been an issue in New York, but it sure was in PJM.
I'm not going to take on the $1,000 bid cap because it wasn't in my homework assignment. But I guess I want to respond a little bit to Margie. There are ancillary services like voltage support, which is done on a cost of service basis that never changes, and maybe those are one category. And then there are ancillary services like regulation reserves, where we have reserve demand curves and so forth. I'm surprised to hear that you can't hedge against some of those, and I assume you could.
You're right, but I think a lot of things actually do get thrown into that voltage market a lot more than, and particularly, I'm sorry, but I'm going off of a PJM experience. We had millions of dollars in reactive charges, and we actually went to the generators and said, can we buy this? Can we buy, reactive voltage. Can we buy it directly from you, the generators, because we can't hedge it. So the problem is when you have ramping and these flexibility requirements, it often does go into this unhedgeable bucket. But you're right, reserves, but that doesn't really go to flexibility, that goes to resource adequacy. That's what I'm concerned about, is we do need more flexible units, and how do you price them? That's not really a supply issue. And there they get into these thornier ancillary services that you can't buy it from a generator and then we're exposed to it. That's my concern.
Okay, and then there was just a very short second component to my comment, which was why, again, we think these costs should be in the ancillary service markets. For example, the demand curves for the Lower Hudson Valley and New York City have baked into them costs for dual fuel capability. And I'm not going to debate whether dual fuel capability is a good idea, but since there's no requirement for all resources to have dual fuel capability, or even for all new resources to pay the cost to implement that, by including it in the demand curve costs, we are giving a windfall to those resources that choose not to invest in dual fuel capability. And so, rather than having trying to build in requirements in the demand curve that only a subset of the people receiving demand curve capacity payments are going to invest in, we think it's better to have targeted ancillary services markets.
Can we have another tech conference on dual fuel capability?
Commissioner Moeller, I'd just like to make one point in terms of the energy markets. I'm not an operator, I'm a finance guy, but having gone through the winter and talked a lot to operators, I would recommend that since there is a lot of discussion around the polar vortex and how markets and how the system performed, just go out and talk to actual plant operators, guys and women who were pushing buttons, who were managing markets, procuring supplies, dealing with barges, dealing with the frozen facilities and all of that stuff, and see how what they say about how the markets perform.
Well, I've also been struggling to come up with a good show tune, but I haven't found a perfect one. But all I can think of is that Meryl Streep chick flick, It's Complicated. But I do know that it's intermission, so we will resume at 1 o'clock. I want to thank this panel very much for their good, terrific discussion.
There's no